You know we like our dividends. This company pays out a quarterly dividend, which is started in the June quarter of 2021. We gotta fatten our pockets. What do you guys think? I like these two energy stocks. Drouinaud Jr., if you're new here, I do cyber-related videos. So, I want to talk about this. Continued inflation. We might be in a recession 2023. These two energy stocks may be a must-have. Okay? Let's talk about it. This is courtesy of Tip Ranks at Yahoo Finance. The price of gasoline has dropped sharply in recent weeks, bringing a welcome relief to anyone with a car. But the fact remains that gas is still up more than $1.50 per gallon on average since the beginning of 2021. It's been a major driver of inflation, and according to the latest numbers for August, inflation remains high at 8.3% annually. Much of that number is driven by increases in food and housing costs, but energy prices are also contributing, and this could, longer term, be a boon for energy investors, even as overall markets dive on the news that inflation is not moderating as quickly as had been hoped. So we have our first energy stock, right? It's Northern Oil and Gas, NOG. First up is Northern Oil and Gas, an exploration and production company involved in the exploitation of the hydrocarbon resources of Williston Basin of North Dakota and Montana. This is the formation that got the U.S. fracking boom started, and it's still one of North America's major oil and gas production regions. In addition to the Williston, Northern also has productive holdings in gas-producing shale formations of New Mexico and Pennsylvania, and has more than 200 million barrels of oil equivalent in proven reserves. All of that puts Northern in a strong position to gain as product prices go up, and the company has seen rising revenues, rising earnings, and a rising share price all year. At the top line, total revenues hit $441 million in quarter two in 2022. A huge increase from the $25.8 million reported in the year ago quarter. Earnings are also up strongly year over year, growing from 92 cents per diluted share in quarter 2 2021 to $1.72 in the current report, which is an 87% gain. Yes, sir, Bob. The solid results have generated plenty of cash too. NOG reported having free cash flow of $114.3 million in the second quarter. The company has been using its cash to support the stock and return capital to shareholders. Northern repurchased $12.8 million worth of common shares in quarter 2 and has bought back at least $7.2 million worth of shares so far in quarter 3. The company also pays out a quarterly dividend. You know I like my dividends. You know we like our dividends. This company pays out a quarterly dividend, which is started in the June quarter of 2021. The dividend has been paid out for 6 quarters and has raised 5 times. The current payment of 25 cents per common share is up from 19 cents in the last quarter. At its current rate, it annualizes to $1 and gives a yield of 3.1%. As can be expected when revenues and earnings show growth of that magnitude, the stock has strongly outperformed. Shares in NOG are up 57% year to date, far ahead of the 16% year to date loss in the S&P 500. 5-star analyst Neil Dingman of Truist Securities sees the company as a sound choice for return-focused investors. Writing, unlike most E&Ps to date, the company maintained both its 2022 production and CapEx guidance issued in June. We view the higher than forecasted quarter 2 2022 capital spend as largely positive given the solid organic activity and ground game that we expect will undoubtedly help set up for improved late 2022-2023 production cash flows. NOG remains focused on its active shareholder returns that continue to run ahead of plans along with a better than maintenance capital type program. Dingman goes on to give NOG shares a buy rating, and his price target of $63 suggests a robust 97% 1-year upside for the stock. Overall, NOG has picked up overall, NOG has picked up 8 recent analyst reviews from the Wall Street analysts, and these break down 6-2 in favor of buys over holds. For a strong buy consensus rating, the stock is selling for $32, and its $45.25 average price target implies a 41% gain over the next 12 months. Wow. Next, we have APA Corporation. Next up is APA Corporation, the holding company that owns Texas-based Apache, another North American oil and gas exploration and production firm. APA's operations are located mainly in the Permian Basin, along the Gulf Coast, and deeper out in the Gulf of Mexico. The company's portfolio also includes assets and production in the North Sea off of the UK and in Egypt's Western Desert, as well as exploration rights off the coast of Suriname and the northern part of South America. APA saw strong production numbers in Q2 2022, up to 385,000 barrels of oil equivalent per day. The high production generated 1.5 billion in cash from operations, which included 814 million in free cash flow. The FCF was more than double the year ago figure, attesting to the quality of the company's assets and its ability to capitalize on rising oil prices. APA expects to generate 3 billion in total FDF this year, and to return some 1.8 billion of that to shareholders through buybacks and, like you said, dividends, right? The current dividend is 12.5 cents per common share and has been held at this level for 3 quarters and annualizes to 50 cents with modest 1.25% yield. The company saw a total top-line revenue in the recent quarter of 3 billion, up 73 cents year over year, and had net earnings of 926 million or $2.71 per diluted share. Net income was up 193% from the year before. APA shares have gained as well, and despite highly volatile trading this year, are showing a gain of 51%. This energy stock has caught the attention of Paul Chang from Scotiabank, another 5-star analyst, who says of the company, "We continue to follow the cash and think the company's generous cash return model will ultimately win back investors. Based on our analysis, APA ranks the second best of FCF yield and organic cash return out of 17 major upstream-oriented companies under our coverage. We estimate the company could shrink their share base by 45% between end of 2021 and 2026 under our average WTI price assumption of $79. Operationally, we also think the overall investment case remains intact and believe recent setback in Egypt is only temporary, while Suriname continues to offer potential meaning for longer-term upside option. The company should also be well positioned to take advantage of the recent strong natural gas market," the analyst added. Chang backs up his bullish commentary with an outperform rating and a $60 price target that indicates potential for 49% share gains on the 1-year time frame. Scotiabank's Chang is hardly the only bull on APA. One of the 13 analyst reviews on file, right, tend to buy against just 3 holds for a strong buy consensus rating. The shares are trading for $40.56 and have a $54.62 average price target, giving a 1-year upside potential of 35%. Like I said, we gotta prepare. We gotta fatten our pockets. What do you guys think? I like these 2 energy stocks. I like them. Do you like them? Finance stock. Please feel free to watch, like, and comment other videos on this channel. Subscribe now.